Hi everyone, welcome to my channel Leegafinalysis. This is the fourth video of the options series. Previous three were on basics of options, calls and puts, ATM, OTM, that is moneyness, apart from many other small concepts as and when encountered. All these videos have been uploaded in the playlist. If you go to my channel on the YouTube, these are the videos that you will find on options. There is also a playlist with the name Options Basics where all the videos related to options have been uploaded. You can go and check out these videos. Apart from these, there are many other useful videos there on the channel. You can check out those as well. The reference link to them have been uploaded in the I button and also in the description box below. So, how are you finding the series? Many of you have poured in your positive feedback. I hope all of you are liking it and benefiting out of it. Okay, in this video, we will touch upon another important topic related to options. That is understanding the concept of option chain. When we visualize option chain, the first impression that comes to our mind is that of colossal data points. Simply too much data. Indeed, it is collection of data, and for a newbie, it is quite overwhelming. But what if I say you can find out the range of the market, that is immediate support and resistance, simply with these data points, and that too just in a fraction of seconds? Doesn't that fascinate you? Yes, indeed it is possible, provided you know what to look and how to look in the sea of data points that is option chain. Now look at this nifty chart, and by some means, if I can say that this is going to be the range, upside and downside, and also this is going to be the direction of the market, then wouldn't that be easier for you to take a trade? So this is the power of option chain. You can very easily figure out the range, that is support and resistance, and also the direction of the market to a level of satisfaction with the help of option chain. Alright? Option chain actually is quite a vast topic, and it would require hours of video to explain each and every term related to it. But don't worry, you don't have to know each and every aspect of options chain. Our aim is to understand options to the extent where we can comfortably trade in Nifty, Bank Nifty and stocks. Here at Leega, I'll tell you all important aspects of options so that you can do trading very easily. You will know what all are necessary for you, and most importantly, in the most simplest way. It wouldn't be an exaggeration if I tell you that you will start falling in love with options. Okay then, let's get started with the Leega's financial analysis, Finalysis. So before we get started with option chain and explore its related aspects, first try to understand what is option chain. Have you ever seen a hardware catalog of a product, say a simple bolt? This is how it looks. Basically, it contains all important aspects and specifications of the bolt along with its price. If you haven't seen it, then I'm pretty sure you all would have seen at least a restaurant's menu. What does it contain? The dish name, in some cases a small description about it, like the ingredient, etc., the quantity, and of course the price. In a very layman's term, this is the simple most analogy of option chain. It is actually a tabular representation of all important values related to an option of an underlying being traded for a particular time period. So it basically entails spot price, strike price, expiry, last traded price, open interest, volume, and in some cases delta, put call ratio, max pain, and many other values. Whoa, all these terms are getting tangent? Don't worry, I will tell you all that is necessary for you in a very conducive and a simple way. Hold it for a moment. Okay then, let's start with Chintu's example, which we have been extending from our video of option series and will continue along all our upcoming videos as well. Do refer to our videos in case you have missed it. So we have three main characters in this example. First is Chintu, his father, and Leega Insurance Company, or simply LIC. LIC here provides insurance to Chintu's father against Chintu's poor performance in exam. So they calculate heads score, based on which they decide what premium to be charged. So head score is their spot price for a strike price, that is pass marks 60. And likewise, they do it for different strikes and spot prices. So they also prepare a sort of chart of all the heads scores, spot price and strike prices, basically in telling what the premium is gonna be in case of different risk profile of Chintu. So basically it is a ready reckoner for LIC, looking at which they can tell the premium against their head score or spot price. Alright, in my previous video on option Moneyness, I had quickly touched upon option chain and explained the concept of at the money, in the money and out of the money options. I had also highlighted the difference in the Moneyness in case of call and put options with a simple case study of Chintu Pass Ho Gaya and the concept of his pass marks, both number system and the ranking system. Alright, so there is a difference between the Moneyness of call and put option. So the strike prices that are out of the money for the call options turns out to be the in the money for the put options. Till this point, I have already explained in my previous videos. I think you are comfortable with it because it has been explained at length in a very simple and easy manner. Now, we will get into the real business. I will take you directly to the NEC website where we will see the real-time data to understand what it is and how to analyze this set of data for a meaningful interpretation. Alright, so on Google, I will type NEC option chain and click on the first link that appears from NEC India. So this is how the option chain on NEC website looks. To start off, I'll quickly tell you all the basic definitions and terms that you should look at option chain, and then we will delve deeper into it. So the first thing that you should know is the underlying. See, the option chains are available for these three indices, or also you can select any of the stocks that you want to see. Alright. And the second thing that you should know is expiry date. So these are the expiries for which you can see the option chain. You can also select a particular strike price, but generally we select the underlying, expiry date, and that's it. Now coming to the basic data sets. So these are the values that is there in the option chain. So you can clearly see it is demarcated into two parts. One that is left of it and the another one that is right of it. You can see these two areas are marked with different color scheme. The one on right, you can see it is white in color, whereas the one that is on left has a tinge of gray color into it. So the gray color part here signifies the call, whereas the white one signifies puts. So if I go further down, you can see the color scheme pattern reverses. So what was gray here now turns out to be gray here. So I'll tell you why this is happening. Actually, gray parts tell you the strike prices that are in the money. Alright, it can be for calls or also for the puts. So basically what you should know right now is difference between calls and puts, and these are the strike prices. And if you clearly see, this is the line that divides the entire option chain into two parts, the upper half and the lower half. And this value, this is actually in the money price because market is trading at 18,300 right now. Apart from these, we will also see things that are important for you in the option chain. The first one is open interest. Second one is change in open interest. Third, of course, is last traded price or the premium of any of these strike prices. And these are the strike prices. So I can tell you in this sea of data that is option chain, you don't have to look at all the values. So what I have marked here, these four are very important for you, and you should be looking at these values at most of the time. Apart from this, there is another important data that is IV that I will tell you later. So these are the data points that I have highlighted. It is for calls, and similarly the same data point is there for the puts as well. So last traded price, IV, change in open interest and open interest. The same data set is there for the puts and calls option. Alright. So here I have shown you how to see option chain from NEC website. So later in this video, I will also tell you two other options of looking at option chain where you will not only get these data, but also important data like max pin, IVs and PCRs. Alright. So as I have told you, option chain is such a vast topic that separate videos can be made on each of these data points. So these are 6 things that we will focus on while we are doing our option chain analysis. So the first one is open interest. As the name suggests, it carries a lot of interest and it is quite interesting too. First understand, it is not explicitly spelled anywhere, but open interest depicts seller's value. Therefore, for all our practical purposes, we will assume that Y values at any strike price signifies number of selling contracts at that level. Alright, so we can see 52,000 contracts at 18,600 Nifty levels, whereas there are 1,745 puts contract at the same level. Alright, we can safely assume that there are 52,000 open interest, or these many calls contracts have been sold at this level, whereas these many put contracts have been sold at 18,600 levels. Take a note of this fact. This is going to be very important all through your trading journey, that open interest can be crudely said that it signifies number of selling contracts at that particular strike level and for that particular expiry. So before we move ahead, I would like you all to be familiar with two more terms, that is option selling and lot size. So previously in my second video on options, I had told you about call and put options. I told you that when you expect market to go up, you buy a call option. Whereas when you expect the market to go down, you buy a put option. So when it comes to selling, it is just the reverse of this. So when you expect the market to go up, you basically sell the put option. And when you expect the market to go down, you sell the call option. So you sell a call when you expect the market to go down, whereas you sell a put when you expect the market to go up. So it is just a reverse of this. All right? Confusion? Give yourself some time for this to sink in. Revise it in case you have any doubt, because this may be confusing sometime. Get yourself through with this fact, as it is quite important for your trading journey. Not to mention those who want to sell options or who want to become option sellers. Alright then, let's move to our next fact, that is lot size. So unlike stocks where you can buy and sell any quantity you want, say you want to buy 5 shares, 10 shares, 50 or even 131. You can do it quite comfortably as long as it is a whole number. But that's not true in the case of options. You can do so only in multiple of a lot size. So a lot size is a basket of quantity that you can buy or sell at a given time. It is different for different underlyings. So for Nifty, the lot size is 50. For a bank Nifty, it is 25, where it is 250 in the case of Reliance and 1500 in case of SBI. So if you wish to buy one lot of a Nifty, basically you are buying 50 units of that underlying. Similarly, when you are buying one lot of Reliance, you are actually buying 250 shares of Reliance. Alright, clear? So coming back to the option chain now, as I have already told you, that open interest signifies the number of open contracts at that particular level. So if say market is at current level of 18,300, so there are 71,146 call contracts at Nifty's this level. So it is a dynamic value and keeps on changing with time. Sometimes you will find that these values are different. There, instead of lots, they would have mentioned you the exact quantity of Nifty. So as I told you that I will show you two another ways to look at option chain apart from NSE's website. So the first one is through Zerodha. So if you log into your Zerodha account and if you select any of the indices that you want to see the option chain, so all you have to do is that particular script, click on more, and there at the last you will see option chain. So when you click it, it will give you a small window showing the option chain that is near the at the money level. So if market is at 18,300, so this will show the strike prices that are near this. So if you want to see the entire option chain, you get the option here, see the full option chain. You click on this, you will get the entire option chain similar to NSE website. Alright, so we'll see the values are different here. Here it is 35.6 million contracts, whereas here it is in number of lots. So you can see the difference in numbers. So if you multiply this by 50, you will get exactly the same value. Alright, so this is the option chain of Zerodha. Here an advantage is that apart from basic option chain, you also get to see the Greeks. Alright, so you go to settings and you can see all these options apart from basic data that is there in the. So apart from basic option chain data, you also get to see Greeks here. Alright, so you can select any of these if you want. Now let us go to Opstra. For that, we'll go to Google, we'll type Opstra. The first option that appears, we'll click on that, opstra.defineage.com. This is the landing page. You log in with your free account here, go to open interest, click on the option chain. This is how the option chain looks. It gives all the data similar to NSE website. Apart from that, there's an option of option Greeks as well. So if you click on that, it will give you all the important Greeks for every strike. So these two websites, Zerodha's Sensible option chain and Opstra's option chain, are quite useful and free for use. Let me make this disclaimer. Neither of these websites are paid promotions. You can use it if you want. So now the question is, why should you know about the open interest? Well, it has very important practical significance. It signifies important support and resistance level for any underlying. As I told you, option chain signifies seller's value. This number signifies the number of sellers at that particular strike level. And we also know that selling calls means we expect market to go down. So if we closely look at open interest, we'll see the highest open interest is at 18,800. Alright. And the second highest is at 64,400. So we can safely assume that the maximum number of sellers are sitting at 18,800 and 18,700. Similarly, there are significant open interest at 18,500 and 18,400 as well. So all these levels become very important resistance level for Nifty for this particular expiry. Similarly, if we look at put options, we will see that this level where there are 93,000 contracts and this level where there is 1 lakh contract. So at 18,200, there are a lot of put sellers sitting at this level. So they wouldn't let market to fall beyond this level. So the safe range that we can say here for this particular expiry is between 18,200 and 18,700 or 800. So you can see at the lower level, the market is quite bullish. So finally, what is the interference of OI analysis? It gives us important support and resistance level for a given underlying and for a given expiry. Basically, it gives us a range to trade for a given time period. Higher the value of OI at any level, stronger is the support and resistance at that particular level. Alright. Now the second important data point is change in open interest. This is also a very good indicator for option traders. It helps us in knowing how strong or weak any support and resistance level is at any given point in time. So if you go at Zerodha's website and you look at open interest change, it is shown in terms of percentage. So at any level, if you see an addition in the open interest, you can safely say that that is becoming stronger support or resistance level. And if I say there is 108% increase in the open interest at 18,400, then we can safely say that for this expiry 18,400 is going to be a good resistance. Similarly, for the put option, here at 18,200 you can see there is a significant increase, that is 117% in the OI. Then we can say that this is going to be a important support for this expiry. So clubbing both open interest and change in open interest, we can clearly see what are the levels that is going to act as important support and resistance for this particular expiry. Similarly, green values signifies addition in the contract, whereas red values signifies decrease in the open interest. So when you look at it in terms of percentage, it gives you a clear picture. Otherwise, by just looking at this raw data, you can say same interpretation. This is the maximum change in OI. So this level, whereas here you can see maximum number of OI being added. So these two levels, that is 18,200 and 18,400, turns out to be good support and resistance level for Nifty for this particular expiry. Now the third most important value that you should look at option chain is last traded price, LTP, or simply the premium. So LTP is different for calls and puts for the same strike value. So for 18,300, calls last traded price is 105 rupees, whereas it is 141.95 for put option. So you can see the difference. For calls, it is out of the money value, therefore the prices are less, whereas for puts 18,300 is in the money and therefore the prices are higher. So as you go in the money, the prices keep increasing. This is true for calls as well as for puts. So as you go down, you will see LTP increases. All right. It basically shows what a strike is trading at what value. So option traders basically keep option chain quite handy for seeing the premiums for trading different options. It is quite simple. Now comes the PCR value. It is again a nuanced topic and need a separate dedicated video. And I must say, this is quite important, particularly for option sellers. In case you want to understand the sentiment of the market, whether it is bullish or bearish, we have to know the PCR. PCR is nothing but the ratio of put to call. So you can calculate the PCR for any particular strike level by simply dividing the put open interest by call open interest, or you can do it for the entire market as well. So for that, so if you come at the last row of the option chain, you will see total value. So this is total call contracts and this is total puts contract. So if you divide puts by calls, as you can see, puts are lower than calls, its value will come less than 1. So it is basically assumed that when the market is between the range 0.5 to 0.7, then market is bearish because the value is less, so puts are lesser in comparison to calls, but below 0.5 or 0.7 it shows oversold condition and market can reverse at any point from these levels. Similarly, when the PCR level is more than 1.3, 1.4, 1.5, then you can say the market is in overbought condition and it can reverse anytime. So far we have learned that put OI signifies support level. Put seller expects market to go up and just reverse. Call seller wants market to go down. So PCR shows put to call ratio, that is put sellers versus call sellers. So if PCR is ever 1, that means there are more puts sold than calls. Therefore, market sentiment is bullish at that particular level. All right. So how will you calculate the PCR? By directly dividing the number of put open interest by the call open interest. If it comes more than 1, then that is bullish, and if it comes less than 1, then it is bearish. But if it comes less than 0.5, then it is too bearish and market can reverse at any point. Similarly, if the PCR comes more than 1.5, then it is too bullish and market can reverse any point in time. Now comes the Greeks. IV that you see here is nothing but one of those Greeks. There are 5 Greeks that I will explain in the upcoming videos because it is a very deep concept and just mentioning it here wouldn't serve the purpose. So I will explain each of those important Greeks in details in upcoming videos. So out of these 6 important topics, we have already touched upon first 4 so far till PCR, and now comes Max Payne and Greeks. There are 5 Greeks. All right. Out of these, 3 are important, that is delta, vega, theta. All these 3 I will discuss in detail in upcoming videos. But these values you can extract directly from option chain. All right. Not all option chain has all these values, but we will see how to get it. So if we go to NSE website, so this IV value is nothing but one of the Greeks. So at any given strike price, say 18,300, the IV is 11.98. All right. So how to read this data and how to analyze it, I will discuss it when I will discuss the Greek. All right. Now comes the delta. So this basic NSE website doesn't has delta into it. For that, you will have to go to either Zerodha's website or Opstra. All right. In Zerodha, you can see the delta is there. Apart from these, all these Greeks you can see in this table itself. All right. It is very important feature. So if you click on any of these, so if I want to see delta plus vega, I will just click it on. And here you can see similarly on Opstra. Go to option chain part of it, click open interest, go to option chain, and here you can see option Greeks option. So once you click on this, you will get all the important Greeks at all the important strike prices. All right. So these are 2 free and easy way through which you can see the option chain and its analysis very easily. And I'm pretty sure many of you might be using many other ways through which you can see the option chain. If you're doing so, don't forget to mention them in the description box with the appropriate link, as it will be helpful for other viewers as well. Alright. So what I want to say is that exploring Greeks at this point is useless, because first of all we will have to understand what the Greeks are and what are their significance. Without knowing all this, looking at the Greek doesn't carry any meaning. Therefore, first of all we will have to understand the Greeks. This is what is going to be the topic for our next video. Now coming to the last point, that is max pain. Max pain is nothing but the level at which the market will expire. If I have to show you on the Opstra, I will go to open interest and I will click on max pain. So if you look at the max pain value, 18,200 is what it is showing. So it is nothing but it shows the level at which the market is going to expire. So again, it is a nuanced value and its analysis needs a separate video. So maybe later sometime I will come up with separate video explaining the max pain in detail. So this is one value which is not available in the NSE website. For this you will have to take the paid subscription of one such website. So I will not delve deeper again in the max pain, but I will tell you that this is how you look at it, and this is nothing but one value at which market is more likely to expire. The level at which buyers will have maximum pain when it expires at that level. Alright. Again, for option seller, this could be one of those data points through which they can do better analysis. So here is the quick summary of whatever we have learned in this video. So in the next video, we will explore 3 concepts of Greeks and how they are important for option trading. I think that is going to be the most important topic of option series and most feared and misunderstood one. So don't miss out on watching those videos. Looking forward to see you all there. Bye bye for now. Do take care of yourself and your loved ones. On that note, I'm signing off. Bye bye.